first topic is business environment and concepts with regards to corporate governance. What's the definition of corporate governance? The sum of procedures and foundation created by a board to communicate, direct, manage, and monitor the actions of an organization and moving it toward accomplishing its objectives. First of all, who belongs on the board? Those are the ones who are elected or assigned group of individuals who jointly monitor the activities of a company or entity. Its activities are steered by authorities and responsibilities given by another authority, normally the stockholders, or in the case of a non-for-profit organization, it would be a donor. So there are 8 basic board of director duties with regard to financial reporting. So those who are on the board have to be very cognizant of what's going on in the financial reporting process, and here they are. First of all, review and monitor corporate procedures, which start from the very basic operating procedures all the way up through strategic that would be done by senior management, including financial plans. Then establish policies of ethical conduct and oversee adherence to those policies. It's very important that board members establish a tone at the top because it permeates throughout the organization. This can also be enhanced by management, of course. Then to understand the corporate risk profile and monitor risk management programs. Obviously, each organization has a different risk portfolio, and this one is just generic in style, so each board has to tailor it towards their specific needs. Then comprehend the organization's financial statements and oversee adequacy of all internal controls, especially and including financial controls. Further going on, monitor Chief Executive Officer compensation and goal setting. Obviously, this is a very important job to make sure that the wishes of the stockholders are being carried out by the agents, in this case, the CEO and other members of the senior management.
They talk about leasing as a form of financing. Leases as a form of financing. And I have to keep remembering that we're all not studying all 4 parts at the same time anymore. So BEC may be one of the first ones you're doing, and you may not have had this in FARE. So let me just go over with you what we look at in FARE. You've got 2 kinds of leases. You have what's called a capitalizable lease, and you have what's called an operating lease. And we've got some criteria, and you can go through that kind of thing when you get into FARE about what constitutes capitalizable, what constitutes operating. Basic rule is if you control the asset for the majority of its useful life, then you bought it, therefore we're going to act as though you bought it. So you're legally renting. It's called substance over form. I don't know if you've run into that concept. It's called substance over form. Form says you're renting this copier. I have a copier in my office. So you're renting this copier. But then you go to the accounting side and say, if you control that copier for the majority of its useful life, accounting-wise, substance-wise, we're going to account for this as though you bought it. So legally, you rent it. Accounting-wise, you bought it. So you make this journal entry here where you debit leased assets and credit leased liability, and then you would amortize this through depreciation, and you would charge interest cost on this in terms of your expenses. Now, if it's an operating lease, then that's the simple one. That's the way that most of you would have been taught in Principles 1 to deal with a lease. There's no journal entry on acquisition, and your only cost is the rent expense. And the rent expense, in theory, would be about the same thing you had up here for depreciation and interest. So why does it matter? Okay, the point we're trying to make here in the book is that if you have a lease in which you have to capitalize the leased asset, that's going to increase your assets. So when you do return on investment is net income over total assets. So return on investment is net income over total assets. So if you add assets here because you've got a capitalizable lease, your rate of return is going to go down. You cause the denominator to go up. Whereas if you could write the lease so that it's going to qualify as an operating lease, it's not going to affect your assets. You have the same net income, and therefore you're going to have a higher return on investment with an operating lease than you will on a capitalizable lease.